Welcome to the deep dive. I want you to just look at your grocery receipt for a second.
Yeah, that's a painful thing to do right now.
It really is. I mean, think about the feeling you get when you realize a standard loaf of bread is suddenly pushing $6.
Right. Or when filling up your car just takes this noticeable,
Yeah,
huge bite out of your weekly budget.
exactly. Now imagine waking up today, Saturday, May 23, 2026, and realizing that this feeling isn't just some temporary glitch.
Because it's not.
No, it's not. You are looking at a world that is teetering on a geopolitical and economic knife edge. The old rules of money simply do not apply anymore.
They really don't. I mean, we are standing at a very precarious intersection right now. We have a massive physical supply chain crisis colliding with a fundamental shift in global financial leadership
Right.
and an inflation problem that is effectively rewriting the textbooks on modern economics.
Okay, let's unpack this. Because to understand why your wallet feels so incredibly stressed right now, we got our hands on a fascinating, newly published analytical paper. It's by Dr. Farid Novin from the Global Review.
Yeah, and this was submitted just weeks ahead of the pivotal 52nd G7 summit in Evian-les-Bains, France.
So the mission of our deep dive today is to decode the hidden psychological forces driving this chaotic global economy, right?
Right.
Understand the physical mechanics of the inflation we're seeing and really map out what this actually means for your savings over the next couple of years.
And Dr. Novin's text is critical here because he isn't just, regurgitating headline numbers. He's looking at the architecture underneath those numbers.
Just structural stuff.
Exactly. The
Sure.
deep institutional tensions and the structural changes in how everyday people expect prices to behave.
Well, we have to start with the immediate catalyst for this report because it happened literally yesterday, May 22, 2026.
Right. The Fed.
Yeah. Kevin Warsh is sworn in as the new chair of the Federal Reserve following a deeply divisive 54-45 Senate vote. He inherits an economy facing the highest inflation in 3 years.
And he was nominated under an explicit, highly publicized political mandate that he would cut interest rates.
Right, to provide relief. But then, on the exact same day, outgoing Fed Governor Christopher Waller goes in front of a microphone and publicly warns that the Fed's next move is just as likely to be a rate hike.
A hike, yeah. Not a cut.
And sitting quietly in the background, you have former Chair Jerome Powell, who remains on the board as a rank-and-file governor until 2028. It is a wildly dramatic dynamic.
It really is unprecedented.
I mean, it's like being on a commercial flight where the airline just hired a brand new pilot specifically because he promised to bring the plane down to a lower altitude.
Right.
But the co-pilot and the legendary old pilot just chilling in the jump seat, they're looking at the radar and warning the cabin that they actually need to pull up.
That is a highly accurate way to visualize the institutional tension at the Fed right now. But what's fascinating here is the reflexivity of this situation.
No reflexivity.
Yeah. Dr. Novin frames this as a five-actor game. You've got the Federal Reserve, financial markets, households, firms, and geopolitical actors.
Okay.
And they aren't just reacting to the economy. They're reacting to what they believe the others will do.
Hold on, I need to stop you at reflexivity. When Warsh is the guy with his hand on the throttle, why does a microphone comment from an outgoing governor even register on the market's radar? Doesn't the chair just make the final call?
Well, yes, the chair has immense power, but the Federal Reserve operates on institutional credibility. Reflexivity refers to the idea that the market's beliefs about what the Fed will do actually alter the underlying economic reality.
Oh, I see.
So if the financial markets believe that Chair Warsh is going to cave to political pressure and cut rates while inflation is running hot, investors will immediately demand an inflation risk premium.
Let's translate that for the listener. What is the actual mechanism of an inflation risk premium? Like, why does an investor's belief suddenly make borrowing more expensive for a normal person?
Think about it from the perspective of someone buying a 10-year government bond. If you believe inflation is going to stay high because the Fed is acting weak, you are not going to lock up your money for a decade at a 3% return.
Right. Because your money would lose purchasing power every year.
Exactly.
Yeah.
So you sell your bonds, and when massive amounts of bonds are sold off, their prices drop.
Right.
And their yields, the interest rates they pay, must go up to attract new buyers. Because government bond yields serve as the bedrock for all other debt, mortgage rates instantly spike. Corporate borrowing costs instantly spike.
Wow.
Yeah, by simply believing the Fed will be too soft on inflation, the markets paradoxically tighten financial conditions on their own without the Fed even lifting a finger.
So to understand why the co-pilot is suddenly screaming to pull the plane up despite the political pressure, we have to look at the radar. We have to trace this inflation data back to its physical source in the real world.
Right, because this isn't just a spreadsheet problem.
Exactly. It begins with the Israel-Iran war that erupted in February of 2026. This conflict triggered the most severe energy supply disruption the world has seen since the 1970s.
It really did.
The attacks in the Strait of Hormuz effectively bottlenecked a channel that handles, what, roughly 35% of all global seaborne crude oil? The math on the disruption is brutal. We're talking a reduction of global oil supply by 10 million barrels per day.
And Brent crude oil surged past $100 a barrel almost overnight.
Yeah. And the fallout in the data was staggering. We are looking at April 2026 U.S. Consumer Price Index rising more 0.6% in a single month. That puts the annual rate at 3.8%, which is the highest since May 2023.
And forecasters are projecting headline inflation for the second quarter to hit a staggering 6%.
But let me push back on this timeline for a second. Usually, when there's an energy shock halfway across the world, we are told it takes a long time to filter down to the consumer level. Why are we talking about a 6% spike so quickly? And, what does this mean for the listener trying to budget for groceries this week?
Well, you have to look at the literal physics of the supply chain. The transmission of energy inflation isn't just one slow wave. It's a series of cascading impacts with very specific time lags.
Okay, so what hits first?
The very first thing that hits is transportation. That happens on day one. It instantly costs more to fill up the diesel tanks of the trucks delivering goods to your town.
Right, the immediate pain at the pump.
Exactly. But then, within just a few weeks, food prices spike, and it goes far beyond the delivery trucks. Natural gas and energy are massive components in producing ammonia for fertilizer.
Oh, wow.
Yeah, if fertilizer costs spike, the cost of planting crops spikes. Then you have the agricultural machinery running on diesel. After harvest, you have cold chain logistics.
Which takes a lot of power.
Right, the massive energy required to keep meat and dairy refrigerated from a processing plant to a warehouse to your local supermarket.
So the energy shock bleeds into the physical production of the food itself.
It does. Then, over the next 1 to 3 months, manufacturing input costs accumulate. Factories use immense amounts of power. Finally, over a quarter, services inflation broadens out. The utility bill at your dentist's office goes up, so they raise the cost of a cleaning.
Right.
Dr. Noven's point is that even if the Strait of Hormuz magically reopened today, this 6% inflation is already physically baked into the pipeline. It is going to wash over the economy for the rest of the year.
Here's where it gets really interesting, because Dr. Noven's paper argues that it's no longer just about the physical barrel of oil or the logistics of fertilizer. The core thesis here is about how this physical event triggers a profound psychological shift. He calls it Bayesian updating.
Right, Bayesian updating. This concept is the intellectual heart of the paper, and it explains why the old rules of central banking are just breaking down. For the entire decade of the 2010s, the macroeconomic assumption was that we lived in a world of structurally low inflation.
Right, inflation was barely a thought.
Exactly. If a shock happened, it was viewed as a temporary anomaly.
But the report points out we are currently enduring the 5th consecutive inflationary shock since 2021.
Fifth one, yeah.
Think about that timeline. We had the pandemic supply chain collapse in 2021.
Yep.
The Russian invasion of Ukraine in 2022. The massive deglobalization efforts in 2023 and 2024. The U.S. tariff shock in 2025. And now the Iran conflict in 2026.
And classical economics suggests that independent temporary shocks shouldn't permanently alter a society's long-term expectations for inflation. But Bayesian probability theory describes how people constantly update their prior beliefs based on new evidence.
Okay, I have to stop you, because let's be real. Normal people and small business owners aren't running Bayesian probability algorithms on a whiteboard while they stock the shelves at a hardware store.
No, definitely not.
It feels more like the boy who cried wolf, but instead it's a central banker crying transitory. If someone tells you the rain is temporary 5 days in a row, eventually you stop believing them and you just buy a permanent umbrella.
That is the perfect translation of the math into human behavior. They don't use the formula, but they absolutely live the reality. This Bayesian drift manifests in very tangible ways.
Like what?
Take that hardware store owner. During the first 2 shocks, maybe they absorbed the higher wholesale costs. They didn't want to lose customer loyalty, and they believed the central banks when they said prices would stabilize.
Sure.
By shock number 5, they stop absorbing anything. They take the new wholesale price, add their margin, and pass the cost directly to you instantly.
Because they've been burned too many times.
Exactly. And we see the same behavioral shift in the labor market. If you're real wages keep shrinking year after year across multiple distinct inflationary episodes, you stop waiting for your annual review.
Have to act.
Right. Workers unionize or they demand larger preemptive wage hikes just to maintain their standard of living. When businesses automatically raise prices and workers automatically demand higher wages, Governor Waller's warning becomes reality. The psychological anchor keeping inflation in check physically snaps. The central banks have burned through their accumulated credibility capital.
And when that credibility is gone, the central bank's primary tool for fighting inflation, which is raising interest rates to cool down economic demand, well, it starts to malfunction. The report outlines two massive structural forces that are essentially neutralizing the Fed's weapons right now.
Two big ones, yes.
The first is the AI boom. We are seeing unprecedented capital expenditure in AI infrastructure, data centers, vast new power generation facilities, thousands of miles of fiber networks. And according to the paper, the spending is inelastic to interest rates. In plain English, are you saying these tech giants are going to drop $50 billion on data centers, regardless of whether borrowing costs 2% or 10%?
That is the exact paradox we are currently living in. Normally, when the Fed raises rates, borrowing becomes expensive, and corporations cancel their big expansion projects. Demand cools, and inflation drops.
Right, that's how it's supposed to work.
But the tech giants building these AI data centers are operating on a strategic, existential, competitive imperative. It is a do-or-die arms race.
Oh, they don't care about the rates.
They do not care about the cost of capital, because if they lose the AI race, their company becomes obsolete. They will build the infrastructure at any cost, pumping billions into the economy and competing for materials and labor.
It's completely impervious to monetary policy.
Entirely.
And that leads to the second roadblock, which is honestly kind of absurd when you step back and look at it, the great fiscal clash. You have the monetary authorities, like the Fed, slamming on the brakes, trying to pull money out of the system to destroy demand. But at the exact same time, the fiscal authorities, the G7 governments themselves, are slamming on the gas pedal.
Pumping money in.
Yes, they are pumping historic amounts of money into the economy through defense spending, industrial subsidies, and massive energy transition investments.
If we connect this to the bigger picture, it fundamentally changes our understanding of the neutral interest rate.
The neutral rate.
Yeah, in economics, the neutral rate is the specific interest rate that neither stimulates nor restricts the economy. Because governments are injecting immense structural support to rebuild power grids and arm themselves in a hostile world, and tech companies are building data centers at any cost, that neutral rate has been dragged significantly higher.
So a federal funds rate of 3.50% to 3.75%, which feels incredibly high to a normal person trying to secure a mortgage, wait, it might not actually be slowing down the broader macroeconomic machine at all.
No, it might actually be accommodative. It's a tug of war where the Fed is pulling one way and the governments and tech monopolies are pulling with twice the force in the opposite direction.
Wow.
And this entirely overturns the thesis that Chair Warsh held before his nomination. He previously argued that the AI boom would boost worker productivity so much that it would naturally lower inflation, allowing him to cut rates safely.
But the war changed that.
Exactly. The physical reality of the Iran war, combined with this inelastic spending, has turned that thesis to ash.
So we have the full board set up here. We have a new Fed chair, trapped by political promises, soaring energy prices from a war in the Gulf, a psychological shift where everyday people expect inflation to stay high, and massive rate-proof spending from governments and tech.
It's a perfect storm.
It really is. Dr. Novin's paper takes all of this and synthesizes it into concrete probabilities for the near future. And the baseline expectation, what he calls Scenario 2, now sits at a 45 to 50% probability. He titles it Persistent Supply-Driven Inflation with Stagflationary Undertones.
Wow, stagflation.
Let's tackle that word, stagflation. It is universally considered the ugliest word in economics. But why is it such a nightmare for policymakers? What is the actual mechanism trapping them?
Stagflation is a nightmare because it neutralizes the central bank's entire toolkit. It is a condition where you have stagnant economic growth and high unemployment happening at the exact same time as high inflation.
Okay.
If you want to cure inflation, you have to raise interest rates to destroy demand, which unfortunately causes more unemployment.
Right.
But if you want to cure unemployment, you have to cut rates to stimulate businesses, which just unleashes more inflation. The Fed is effectively trapped in a room with no doors.
And under this scenario, we get a hybrid regime. You have the illusion of moderate economic growth, purely masked by all that AI investment at the top. But underneath, you have persistent 3.5% to 5.0% inflation, elevated interest rates locked in well into mid-2027, and declining real wages for the working class. But wait, I have to ask about scenario one, the controlled disinflation. The happy ending where the war resolves, oil drops, and rates get cut safely. The paper says that has dropped to a mere 15 to 20% chance. Why is the optimistic outlook evaporating so fast?
Two critical factors. First, the physical reality in the Middle East. The infrastructure damage to the energy facilities in the Gulf is immense. Even if a ceasefire were assigned tomorrow morning, it will take months, if not years, to rebuild the pipelines and terminals to get that 10 million barrels a day back online.
So the physical supply isn't coming back quickly.
No. Second, the psychological Bayesian drift we discussed. A consumer's mindset doesn't magically snap back to 2019 just because the shooting stops. The data is already showing the damage. In April 2026 alone, real average hourly wages slipped 0.5% in a single month.
That's huge for 1 month.
It is. When people feel that kind of sudden loss in purchasing power, it cements the expectation that the system is structurally broken.
Okay, but a 45% chance of scenario 2 still leaves a massive chunk of probability unaccounted for. What happens if the political pressure works? What happens if Chair Warsh just throws his hands up, caves to the politicians, and cuts interest rates to give people a break while inflation is still sitting at 4%?
That triggers scenario 3.
The nightmare.
The nightmare. Yeah, the paper gives us a 20 to 25% probability. If the Fed capitulates or if the Middle East war expands further, the public's inflation expectations become totally unanchored. The Bayesian dam breaks.
Oh, boy.
We get full-blown stagflation. The only historical cure for unanchored expectations is aggressive, brutal rate hikes that actively and intentionally crush the broader economy to reset the board.
Which is the exact outcome world leaders are desperately trying to avoid, because this isn't isolated to the United States. These shocks are internationalizing economic pain, which brings us to the ultimate focal point of the source document, the upcoming G7 summit in Evian-les-Bains. World leaders are gathering in France to attempt to coordinate a global response.
And the historical parallel is striking here. The G7 was originally created in 1975 for the explicit purpose of dealing with the Middle Eastern oil crisis. Now, 51 years later, they are meeting in France, facing a vastly more complex, multi-layered version of the exact same threat.
But the central problem facing them is divergence. I mean, they aren't in the same boat. Europe is highly vulnerable to energy imports. Their economies basically grind to a halt when oil spikes.
Right.
The U.S., on the other hand, is a net energy exporter, so higher oil prices actually inject money into parts of the American economy, even while it hurts the consumer. And every nation has vastly different levels of national debt and fiscal capacity to spend their way out of the problem.
We saw this fracture very clearly in the pre-summit communique from the finance ministers. It showed deep structural divisions. Kristalina Georgieva, the chief of the IMF, essentially issued a warning to the G7 leaders that boiled down to, first, do no harm, just don't make the situation worse.
Dr. Novin does offer structural recommendations for the G7, though. He argues they need to collectively reaffirm central bank independence to support people like Warsh and Waller, execute a massive coordinated release from the global strategic petroleum reserves to force oil prices down immediately, and establish a framework to manage these Bayesian inflation expectations.
Yes, those are his main points.
But let's talk about the real world here. How can leaders sit in an opulent French resort and manage global expectations when their voters are ready to riot over the price of a gallon of gas?
This raises an important question, and it is really the ultimate conclusion of Dr. Novin's report. We have to stop viewing price stability as merely an academic economic target.
What do you mean?
In a highly polarized environment, price stability is a fundamental condition of social and political sustainability. History is full of examples where runaway inflation breaks democracies. If people cannot predict what their money will buy next month, the political center cannot hold.
So if the G7 leaders act selfishly, or if they allow central bank independence to erode for short-term political points, it just reinforces the public's belief that the system is broken.
Exactly. And when the public believes the system is broken, inflation becomes sticky and self-fulfilling.
Yeah.
The G7 leaders have to tangibly demonstrate that a rules-based financial system can actually navigate a world that is no longer physically or geopolitically stable.
So what does this all mean for you listening right now? It means that the friction you are feeling at the grocery store, the spike at the gas pump, the declining purchasing power of your paycheck, These aren't just temporary blips to wait out.
No, they're not.
You are living through a fundamental structural shift in how the global economy operates. The old normal of comfortable, invisible 2% inflation might be gone for good, replaced by a volatile, geopolitically driven landscape where shocks are the new system.
It's a new era.
It really is. Which leaves us with a profound question to chew on as we wrap up. If the era of the temporary shock is truly over, and we are entering an age of persistent, geopolitically driven inflation, well, how will this change the way a whole new generation approaches saving, investing, and the very concept of building wealth?
That's the big question.
Yeah. If your money is fundamentally worth less every single year, does safe traditional saving become a sucker's game? Does a high inflation world inevitably force us into becoming a society of hyper-speculators just to stay afloat? Something to think about the next time you look at a price tag. Keep questioning the consensus. Thanks for joining us on the Steep Dive.